Ben, we know. Thank you. And who's raised outside capital already? Awesome. Solid percentage of the room as well. And has anybody actually led a fundraise before? Amazing. Cool. So with that, before we jump into it, we'd love to introduce our panelists as well. So Adam, would you like to kick us off?
Yeah, sure. So Adam Swiecicki, I'm the CFO at Rippling. Background, so I came out of school, started in investment banking, so worked at Morgan Stanley in the M&A group, and then did a tour across private and public market investing, so private market investing at Hellman & Friedman. It's a private equity firm based out in SF, and then 2 years at Viking Global. It's a large hedge fund based in New York, so have a pretty well-rounded perspective across public and private markets. Went to business school, and then on the operating side, I've worked at 2 companies. So prior to Rippling, worked at Brex from 2020 to 2022. Entered as head of corp dev there, became CFO, and then left in late 22 and joined Rippling.
Zoe?
Hi, I'm Zoe Perret. I'm a partner at Initialized Capital, where I invest in seed stage founders, typically who are at kind of the intersection of the digital and physical world. So that looks like founders who are building things in energy, climate, frontier tech, and at this point, everything software-based has kind of a backbone of AI that we're looking at the earliest stages. And we are investors in Rippling, as well as kind of 25 other unicorns that we've had kind of the pleasure to be along the journey with. Some examples are Flock Safety, Flexport, Instacart, as well as Coinbase. And yeah, so we are typically trying to find founders like Parker and be along for their long journey.
Amazing. Thank you, Zoe. And my name's Sam Vaughn. I'm the director of sales for Rippling Spend. Easily the least impressive person up here, but that's fine. But to start off, Zoe, I have a question for you. Can you walk us through what raising a Series A typically looks like?
Yeah, sure. And I guess one other kind of component of my role at Initialized is I lead our follow-on fundraising program. So that's helping all of our founders who are at the seed stage raise their Series A and beyond, and helping them through that kind of gearing up journey. And I would say, I don't think it's a surprise for anyone in the room that there's been an evolution of the market over the past kind of 12 to 24 months, and we're finally really seeing an uptick of companies going out to raise. I think we have more companies right now gearing up or who are actively fundraising in the past month than we've had in the past 12 months. And so I think there is definitely a signal, even just within our portfolio at the seed stage, that things are shifting. That being said, it is still extremely difficult to raise even at the A, and you have to be exceptional. And I think what exceptional looks like is a founder who not only has kind of this visionary mindset, but also can execute and has a plan. And I think we're going to spend a lot of time talking about what that planning looks like, what the metrics look like today. But actually gearing up from a tactical perspective, it's getting all of your ducks in a row in terms of the business fundamentals looking exceptional, and also making sure that you have, your data room built, your story put together, your deck, and then ultimately being able to go out and find who are the right partners for you at this stage and finding what VCs those are. So, that's kind of the tactical plan, but I think we'll spend a lot more time on those pieces today.
We definitely will. And Adam, for you, as we go further down the pipe, like what does it look like internally when you're preparing for later stage funding?
Yeah, for sure. So similar to Zoe, I'll kind of provide some context, and maybe some of you have seen this as well. But I think on the later stage side, one of the dynamics to be aware of is many of these investors are both public and private market investors. So they're looking really across the universe of all these companies, both pre-IPO and public companies. And I think the big tone shift that's occurred that I've seen over the last 4 or 5 years that I've been fundraising is a couple things. So first of all, I think there's an appreciation of the concentration of market cap and value in fewer and fewer companies. So you are seeing this flight to quality within late stage companies. There's probably, 5 to 10 late stage companies that if you asked a typical VC or late stage investor about, like they would kind of talk about the same 5 to 10 companies that they would want to put money in. And then second, there is a real question with this concentration in fewer companies, as well as the emergence of AI, of, as we look out 10 or 20 years, what companies are still going to have a business model, and what does that business model look like? And so you're dealing with a lot of these very large existential questions, which does, influence how investors think about investing in your company. Now, with that context in mind, as you think about more tactically, what does it look like to fundraise in that environment? There's a couple of things. I think, first of all, when you enter a raise, first of all, it's kind of like that Sun Tzu quote, like every battle's, won before it's fought. it really depends on everything you've done up until that point. It's not about like raising well. It's about your financial plan. At the end of the day, your financial performance and sort of the company's health is going to dictate the ease of that raise, regardless of how good you are at fundraising. And so for sure, knowing what your financial plan is and executing against that plan and making sure that you are in a good position of financial strength to raise is the most important thing. But then, going beyond that, tactically, you want to be very prepared. And so echoing what Zoe said, I think you want to have all of your ducks in a row in terms of who are the investors that we have good relationships with? Have we invested in those relationships over time? What are the types of questions that they're going to ask? Like, what are the areas of our company that we know are the soft spots that we can anticipate and prepare for? And then, preparing to answer those questions in advance. So for us, typically what we would do, call it a month or two in advance of the raise, is look at what does the data room look like, prepare all those files, what are the initial materials we're going to go out to investors with, put that together. And so you have this very well-defined package that you're launching a raise with, and the raise can move very quickly because I do think, again, on the margin, within reason, strong and fast execution does influence the outcome of a raise. So if you have a good financial plan and good execution, that's how you get to the best result.
And you talked a lot about like how investors will see the company, but as you're going out to raise, like how do you choose the right investors? And as you're going through the stages, like how much time should you spend on each stage?
Yeah, I think so one thing that I've seen at both Brex and Rippling, and it's become more and more important today, is that there's been this dynamic that's changed of like you used to go public at roughly $100 million of ARR. That used to be the rule within software. Now you're seeing companies stay private for longer and longer. And in some cases like Stripe and Databricks, there's the question of whether those companies go public at all. And it's a really interesting trend because I think, there's all sorts of reasons why, and I have to be careful with the NYSE people here, but there's reasons why that's attractive. First of all, you don't have to manage against quarterly earnings, which cause you to do unnatural things to run the company. So that's one. And then two, there's a change in the depth of private markets in terms of your ability to sustain the amount of capital and sort of fund your business, as well as provide liquidity to employees in a way that was not true 10 or 15 years ago. So it really is a new environment in that regard. And you are seeing, and I won't pick specific names, but you're seeing some of these late stage companies that have stayed private have competitive advantages relative to the analogous public peers who have really struggled to invest more heavily in R&D or price in a certain way in order to be more competitive in those markets. And so the reason I raise that context is I think picking the right investors is becoming more and more important. And for us, we spend a lot of time kind of in this transition from like kind of typical venture capital investors to kind of late stage crossover investors. So there's a few different groups within there. It'd be sovereign wealth funds. So companies, you may have heard of these names, GIC or Temasek, or there's some in the Middle East like Mubadala. So sort of that's one group. A second group would be mutual funds. So T. Rowe Price, Fidelity, Wellington, and so on, Capital Group. And then the last would be true kind of like crossover hedge funds. So Durable Capital, Green Oaks, and so on and so forth. And you want to be very thoughtful around building your cap table around these businesses because you want to construct a set of investors who have the mandate and the ability to hold your stock for a very prolonged period of time as a private company and also inject new capital into that business as you continue to grow. Because to run a private company at scale, it can become very capital intensive. Some of you have seen like the $6 to $10 billion fundraisers across Stripe and Databricks. And you don't want investors who are invested in the company where they themselves need liquidity at some point while you're still private and you're sort of trying to fundraise while those companies are themselves trying to sell stock and you're sort of competing in the market against existing investors to sell that stock. So investing in those relationships is really important and being thoughtful around what does that cap table look like and how does that play into your strategy of private versus public over the next 10 to 20 years.
And I think at the earliest stage where we're kind of advising, our companies, how do you think about who is the right partner? A lot of times it's the person. You are choosing your board and sometimes your first board members, and that's a 10 plus year relationship that you have to invest in. And while it's very important to find board members that maybe have a very specific skill set or relationships or partnerships that they can lend to you, whether or not you're going through, monetization for the first time, or you're expanding into a new geography and they've done that, or you're selling into a specific type of customer that they know intimately and have worked with other companies that have done something similar. I think that's incredibly important. But at the same time, having an asshole on your board that's going to make it incredibly difficult to make decisions and to have fruitful conversations, especially when things do not go well, is far more important than what their skill set or where they may have worked in the past. And I think that is the much larger pain point that we've seen is actually the person and the way that they interact with the founder and the dynamic between the founder and the board, and being thoughtful about constructing that and choosing the partner above the firm, above their background is super, super important.
And when you're looking into that from an early stage perspective, you care a lot about the founder, how you're building out the board. But like, what would the differences what would the differences be between like you as an early stage investor, what you care about, and a late stage investor, for example?
I mean, in terms of diligencing a company, it's dramatically different things. When I'm looking at a company, they barely have any revenue. Maybe they have a product. And obviously, when Adam's looking at something, it's totally different. But I think a lot of times for us, it's so important looking at the founder. Again, they set a vision and execute against it. If we're now in a world where with AI, you can spin up companies that all look the exact same and, from a bunch of smart people who all come from great schools and you all are trying to solve the same thing, a lot of times then the question is, okay, is this business durable? And then also, is this founder going to have the adaptability they need to be able to pivot whenever all of these new changes are coming out every single day? And so I think it's the combination of, the business itself needs to be durable. We need to see that there is accelerated growth. I think if we're talking about metrics, sure, it's important that we have year-over-year growth that is exceptional in terms of 3 to 5x year-over-year. But it's also important that we are underwriting the type of person that is not going to sit in a pit when it's not working and continue to try and do the same thing. Because I think that lack of adaptability is what we're seeing as really the killer right now amongst the really, really increasing competition landscape.
And looking at later stages, is there anything different that you see as well?
Yeah, Zoe alluded to it, but I definitely think, back to my comment around the investors you're talking to, they're used to looking across the universe of public and private companies, and because of that, they are comparing you to those companies, and it's a much more metrics-driven approach. So, there's this evolution of like looking at the founder and idea, looking at metrics that are pre-revenue, like users or other leading indicators of revenue, to like revenue as a late-stage private company, to starting to look at profitability. And so, as a later-stage company, you start to think about not only is this company, are they growing, and do we believe in this company's product? Which I think the math would still tell you growth is far and away the number one indicator of the valuation of a company. It's by far the most correlated statistic. That said, profitability starts to matter more, and diving deeper into profitability, because I think one of the mistakes people make is it's a very broad brush term to say this company is unprofitable, or what is their Rule of 40 score. Like, those things are a very blunt instrument. It's really understanding for those companies in particular how scalable their unit economics are. So what investors are really focused on are you growing quickly, and then separately, are you growing quickly efficiently? And so those would be things like CAC paybacks, or relationship of new revenue to sales and marketing spend, or other efficiency metrics, ramp to rep productivity, those types of things. And the reason that's important is because one of the biggest indicators of the long-term margin potential of a company, for most tech companies, the largest bucket of spend over time is sales and marketing. When you start out, it's usually R&D. When you're a mature public company, you would typically see sales and marketing as probably 2 to 3x the spend that companies have on R&D. And so having a very efficient sales and marketing engine is the most correlated metric to long-term profit margins for a business. So, those I would say are the main things. Now, I would also kind of call out, there's kind of this interesting dichotomy just listening to Zoe's commentary on investors, where, I was sort of saying, almost like we're focused on the mandate, the structure of the investor, sort of how long can they hold the stock. We're not talking about board members or people at all. Whereas, from the early stage side, it's very important who's on your board, and it's very important to focus on people. And similarly, on the investor side, they're very focused on the founder and who that founder is, and I'm describing like a very metrics-driven approach. That said, I think the one nuance here is I still think, and I firmly believe, there's a huge value if you can find a company that has a founder that can scale with that company and remain founder CEO through IPO. And so if you look at all of the greats, if you look at Amazon with Jeff Bezos, Meta with Mark Zuckerberg relative to other companies that brought in professional CEOs, there's just a total difference in terms of execution, the soul of the company, and things like that. So that is one area where I think there's more commonality between early and late stage that the founder still matters.
That makes a lot of sense. Thank you. And once we're actually talking to the investors, like how do we decide how much money to raise and what the company's valuation ultimately should be?
Sure. I mean, I think the easiest way to think about it is you work backwards from what your milestones are for the next raise. So if we're advising a company at the A, a lot of times all they really need to know at this point is how much money do you need to get to your Series B milestones, and working backwards from your model in terms of, okay, what does that revenue look like? What does that headcount look like? Et cetera, et cetera. And I think a lot of times the valuation in the best raises I've seen is oftentimes dictated by the investor, right? Like you get the term sheet with the valuation. Sure, there's kind of a multiple on that. Sometimes it's on revenue, sometimes it's not at all. And I think it's less so that a founder is coming to the table and saying like, this is the exact amount that I'm raising, and this is the exact terms, and this and this. Oftentimes it's an organic process. And I think sometimes, the founder has the optionality to at least signal what they're looking for in terms of valuation and the amount of dilution that they're willing to take. And I think investors are oftentimes receptive to that. But on the flip side, investors also have the same requirements. They are looking for percentage ownership, and that's how they're factoring in how they're getting to their valuation in the end. But in terms of the kind of the tactical process of figuring out how much to raise in the valuation, it's all based on what the milestones are for the next raise oftentimes.
Yeah, and I think there is, it's a common theme. There is a change in how you approach fundraising and these questions as you go to the later stage, because as a founder, most of your dilution is going to occur in the early stages of the company, just because the amount you're raising relative to the valuation of the company is very high. At later stages, like the amount of dilution for a given raise starts to become very, very small, relative to what you see in earlier stages. And there's a few implications of what that means. And I think the way to think about this is the price for your company is always set by the marginal buyer. And you don't want to be in a position where there's a huge drop off between the last dollar you raise and where the next dollar is coming from. And so what that means is typically for most fundraisers, we're raising well below the price that we think we could actually go and raise at if we only optimized on price. We like to be something like 2 to 3x oversubscribed on the amount that we're raising at. And there's a couple of reasons for that. First of all, there's a possibility that you might have to go back to market relatively quickly. M&A comes up or some other reason that you need to go tap into capital, and you want to be able to do that and know that the price or the amount of capital at the price you just raised at is very deep. And then second is that's an indicator that you're probably raising at a price where if you roll forward the financial plan a year or 2 years, you can pretty comfortably raise at an up round. So you're not kind of like levered to you have not like optimized for price so much that everything has to go perfect, such that you can raise it at a higher price a year later. So what we usually do is we take our financial plan, we reverse engineer into what do we think we will be raising at a year from now? How much buffer is there relative to the raise that we're doing today under a variety of market conditions? And making sure like, hey, if the market multiples trade down 10 to 15%, if our financial plan comes up a few percentage points short, do we still feel comfortable that we could raise at least flat, if not up? Just because I think everyone here is aware of the fact that companies are so levered to their share price in terms of employee morale, the value of the equity, which leads to retention of employees. If you have a down round, there's massive dilution events to keep employees happy. And so you just really need to make sure that you're continuing to put yourself on a path for consistent share price increases.
And I think you hit on a very important point that we've seen within our own portfolio is we had many companies go out in 2021, the valuations were crazy. They were not at all justified to kind of where the business was today. And maybe they were raising a Series A at valuations that would typically be for a B or beyond. And now that we've kind of come back to our senses to some extent in terms of underwriting to real economics, those companies are having to wait a much longer period of time to really grow into the metrics that justify the next round. And so that also comes into play in terms of cash management and how they're thinking about their runway and everything that comes between those two phases. And so I think it is important to note that while sometimes maybe the market will provide a price, like you still have to justify it over time. Like it comes back and will bite you if you don't actually grow into it in terms of justifying it from a business perspective.
And Zoe, a lot of founders would want to know, like, what financial numbers or goals do I need to hit to guarantee that I grow into $1 billion company over time? What would your advice be to them if they came to you with that question?
Well, I would say that if it was that easy to guarantee that you would become a unicorn or $1 billion company, then there would probably be more of them. And I think that oftentimes is a little bit of a misconstrued perception that founders come with, like, hey, what's a scorecard for raising an A? Hey, what's a scorecard for raising a B? And we've tried this exercise internally, and we tried to make, scorecards for consumer, scorecards for consumer hardware, scorecards for consumer healthcare, like every version to try and segment it to make it more clear and more clear and more clear. And at the end of the day, back to kind of my original point, if you're not the outlier, you are not going to raise. And so giving a scorecard to all of the founders is essentially advising to the average, and oftentimes the average is not who is raising. But if we had to put numbers on the board, I do think that having growth rates, like I was saying, between 3 to 5x year over year growth is really important on the revenue side at a Series A. I think having really low churn numbers, I think having a clear and really high quality sales pipeline that the next investor can understand that giving you $10 to $20 million, really you're just kind of pouring fuel on this fire, and you're going to go and close those contracts because you already have the relationships or at least somewhat of this funnel built out. I think all of that's really important.
Amazing. And so once we actually raise that funding, and Adam, maybe we start for you on this one, how would you build a solid plan for how to use the money once you get it? So what are like the key goals, metrics that you're going after, and how does that change in the different stages that you go through?
Yeah, I think dovetailing off of the last question, I think the most important thing kind of going into the fundraise is understanding where is this company going. So usually what you would have would be a long range plan, and underneath that long range plan you have the drivers that are required to achieve it. And so as you think about how the company progresses post raise, you're really thinking about, hey, in the next year or 2 years, what do I have to do to raise at an up round? What does that financial plan look like? What are the things we need to achieve? And really investing behind that. And there's a few different things that I would share just as tips or things that I pay attention to. So I think the first thing is you want to make sure that when you look at where the investments are going, that they're appropriately geared towards growth. So think about sales and marketing, think about R&D, and that there's not a lot of waste in G&A functions and other things that look like that are not kind of contributing to growth in that plan. The second thing I'd say is I think sometimes there's a tendency for people to kind of sprinkle investments across everything. And I think you need to understand what are the key bets and what are the biggest levers that are required to be true in order for us to hit this financial plan that we've set forth. So those are a couple of things to think about, because I think there is a tendency of sort of everyone raises their hand and you kind of dole out like 5% of the budget to everyone, and that's a big mistake, and it sort of guarantees failure for everyone. And then I think the last thing that I would say is you also want to remember during your next raise, at that time it's kind of like the Steve Jobs of like one more thing. At that point of the raise, you will now be looking forward a year or 2 years out, and you'll want to be able to talk about something that's exciting for the investor and showing them what is the next leg of growth in the story. And one of the things I found to be really difficult in startups is, you're so focused on execution this month, this quarter, maybe this year. It's often hard to think about 3 to 5 years from now. So going back to a common quote, it'd be the Jeff Bezos quote around like, hey, my earnings were kind of baked 3 years ago. So like, thanks for the congratulations. But, we kind of already achieved this based on decisions that were made, long before today. And that really holds true. Like, I think many of you know, if you're not going to hit, if you do not see a path to hit your growth target sitting in October, you are not going to invent a product that moves the needle for the following year. It takes time to build that product, to figure out how to scale it, and then to execute against that. And so you really need to be thinking on a 3 to 5 year time horizon at the later stage to make sure you are set up for this series of raises over time to continue to sustain that growth at scale.
And Zoe, like Adam mentioned, the common mistake of not looking far enough ahead when people do get fundraising. Like, what other common mistakes do you see that startups make after raising money, and how can startups try to avoid these mistakes in the future?
I do think, fundraising is to some extent like the starting gun, and you're on somewhat of a timeline to hit those milestones, and it's a countdown. But a lot of the work can be done in advance to make it such that you already know what's happening the second that you receive the money. And I think some of the best founders we've seen do a really good job of understanding who exactly they want to hire. And I think that is what I have seen as the key differentiator between kind of the pitfalls of people who receive the money and they're like, oh, shoot, okay, well, now I'm going to hire my first head of sales. But maybe you've never hired a head of sales before, and so you don't know what good looks like. And I think that time to get up to speed on learning and potential, challenges with hiring and mishiring and the way that impacts morale of a team, the way that it takes away from the time of the founder, all of those kind of implications can be prevented if leading into the fundraise, you know that you need to hire a head of sales, and you go and you talk to the best head of sales at every other, company in and around your sector so that you do know what good looks like. And that will likely kind of lead to having a pipeline of high quality candidates even before you're ready to hire them. And so I think that's really a key differentiator of what we see between first time and second time founders is that the second time founders oftentimes get to leapfrog through those potential mistakes because they've made them before. And the first time founders, if they are not prepared and they do not do kind of the extra work of trying to understand what good looks like, what the mistakes could be, and learning from others, they're tending to go quite quickly into those pitfalls. So I think preparedness, again, kind of skips a lot of the steps that we see between first and second time founders. And I know that's something that Parker talks a lot about, that he was able to overcome some of the challenges quite quickly, ramp up the teams very quickly because he saw, what that looked like before and what good is today.
And outside of like first time, second time founders, because maybe that's one of the patterns that you'll see, but as we're looking at early stage companies, are there any trends or patterns that you see in those companies that leads them to eventually become a unicorn?
I think I talked about this a little bit before, but it's very much on my mind because we've seen it a lot in the down times over the past 12 months, but it's very much how quickly they can realize that the path they're on is not working. And I think founders, especially founders who've had to shut down their businesses over the past year, we've had them in all of our portfolios. It's the reality of the market right now. I've had a lot of kind of postmortems with them, and every single founder, I think, had said something to the effect of, I wish I realized when I was in that moment and it wasn't working and that I should have just immediately jumped into something else. And trying to kind of dig the hole further and further into the rut is oftentimes, I think, a key differentiator of the ones that are able to move forth. And obviously, later down the line, your timelines are a lot longer, but at the early stage, weeks and months matter. That is a drain on your runway. The second that you're at 12 months of runway, like you're nearing death. And so oftentimes, if you're only starting with 24, 36 months of runway, that's not a lot of time to make the decisions that you need to get to your milestones. And so not being able to pivot fast enough is a sure way to end up not having enough time to make the change that you need.
And when we get that funding, we're like pushing for growth and we want to do it intelligently. Like, how can a founder push for that growth without overpromising or putting their company at risk afterwards?
Yeah, I think it's interesting. There's a bit of a catch-22. I think there's this world where it's like, hey, we set this incredibly ambitious goal that's like almost unachievable, and then we plan against it and we get over our skis and we end up in a tough spot. And then it's like, okay, no, let's plan conservatively and kind of shoot for something that feels more achievable. But then you're sort of guaranteeing by, constructing a sales funnel a certain way, hiring salespeople up to a certain revenue target, that you will underperform your possibilities, and you will not achieve something that's exceptional. And I think the best way, to kind of try to solve this, and what we try to do, is we do plan for ambitious goals, for sure. That's definitely one of, I think Parker's key tenets around, kind of this idea around, you don't have to just do one thing well. We try to do many things well with the compound startup approach. And really the goal behind Rippling is to drive this really unique growth endurance at scale. So high growth sustained at scale over time. And so we plan for that high growth, but there's like a nuanced way that we do that. So on the go-to-market side, we plan for these aggressive revenue targets. But what we're doing is every month we are looking at the performance of the business, my team actually reforecasts the revenue outlook for the year. We look at where are we on track, where are we off track. We actually have over 100 different sales motions within the business. So we're looking at that across all the different sales motions. And there's always a decision around, do we continue to invest marketing dollars in this channel? Do we continue to hire a salesperson in this combination of product, geography, customer segment? And we're making those tweaks and those changes monthly. And so what that allows you to do, back to my comment on sales efficiency, is you never get too far over your skis because you are dynamically planning around, are we kind of on track or not? So that's one thing. The second thing is for things that aren't growth oriented around sales and marketing, we actually plan R&D costs and we plan G&A costs for a much more conservative revenue number. So the way to kind of think about it is we have a board plan, which is much lower than our internal target and our sales goal. That board plan is how we plan our costs. And so we make sure that, hey, if things end up a little bit different than we thought and revenue's a little bit lower, we have a G&A and R&D structure, things that are a little bit tougher to change and teams that will construct themselves in a certain way. If you give them a cost envelope, we make sure those are planned more conservatively. So that's kind of like the nuance in how we plan. And then we have a continuous cycle every quarter where we reforecast the entire business, go to the board members and say like, hey, based on outperformance for the year, I'll make up numbers. We're 20 million ahead of target. We're going to let 10 million of that drop to the bottom line. 10 million of that, we're going to split it 50, 70, in our case, 95% to R&D, 5% to G&A. And that's kind of how we manage the business and solve this trade-off, this surface level trade-off between aggressive goals and conservative targets and not getting too far over your skis.
And in that growth mindset, I know you mentioned the $100 million in annual revenue number earlier, but if you're focused on reaching that number and you can only optimize for 2 financial metrics, what 2 financial metrics would those be?
Yeah. So I'll skip over like the broader answer around like ARR growth, but picking like input metrics that people would focus on, I think the 2 I would say would be win rate and retention rate. And the reason for that, and maybe this is intuitive, but on the win rate side, it's an indicator of product market fit, and also back to sales efficiency. It's hard to have a really inefficient sales funnel if you're winning most of your deals. So, win rate is one thing. On the retention rate side, that again is a very strong indicator of value that customers see in your product. If you have a 90-95% retention rate, and this depends on the business line and who you're serving, but that's a very strong retention rate in B2B software. And I think retention rate in particular becomes very important as you get to the later stage, because if you think about it, sort of like the SaaS business model, the way it works is at 10 million of ARR, if your retention rate's 80%, you churn $2 million of revenue a year. That means you have to go sell $2 million to net new customers just to kind of get back to no growth, and then everything after that's incremental. Now, for us, let's say we're getting closer to $1 billion, 20% churn is $200 million that I have to go out and find in the sales force before I can even think about growing. And the point is, you can't really get to be a scale company. You will never be a $1 billion plus software business without a strong retention rate, because that hole becomes too big no matter how many new customers you're acquiring. So again, on the front end, win rate, and on the back end, retention rate would be the 2 metrics I pay attention to.
Amazing. And on the flip side, Zoe, if you had to pick 2 metrics to decide whether to invest in a seed or Series A company, what would those 2 metrics be?
Yeah, I think if we're avoiding the obvious revenue growth answers, then similar, I think, churn, and then also kind of the sales velocity. So understanding how quickly, the customers that you have in the pipeline are converting and actually, winning those deals. I think that's very important, and something that we're thinking about a lot more as we're entering into this kind of world of AI, and thinking about how, we've seen early stage businesses be able to get to mid, 500K-ish ARR very quickly, but it's a lot more difficult for them to get past the million, the 2 million, and have kind of sticky revenue from large enterprise businesses. And I think that's a key differentiator, and understanding how quickly the contracts are able to convert and stick and not churn.
Amazing. And we've got about 2 more questions, then we can open it up to Q&A for everybody.
Sure.
Before turning it over to everybody, what would be a surefire way to guarantee a company doesn't become a unicorn?
That they cannot hire high quality talent, I think, from the early stage, especially as we are seeing the frontier labs be able to pay an extraordinary amount for key researchers, for key engineers. If you can't attract and retain high quality talent, then incumbents are going to win. And I think it's a key indicator for investors as to whether or not you have the type of leadership that people who are best in class and what they do want to come and work for you for a potential pay cut or a potential higher risk opportunity, especially when we have really exciting things happening now at the big players again.
Is there anything you would add there?
Yeah, I'll double down on that. I think that this theme of people, we talked about it earlier with the founder CEO, talent effectiveness becomes really important. And it's, we've talked a lot about financial metrics today. That's like the one non-financial metric that I pay a lot of attention to. And so what those metrics look like would be, what is your distribution of low versus high performers? Are you exiting low performers the right way? Are you promoting the high performers and retaining those people? And then a second way to look at it would be, hey, for people who are mature at the company, ramped at the business, ramped at Rippling or Stripe or wherever, so they're a year, 2 year, 10-year employees. What is our ability to retain those employees over time? What is the attrition of sort of like long-term Ripplers? And the reason those things matter is those are your most productive employees. And if you think about a startup, it's very different than Microsoft or Oracle or these more mature businesses where the business model is so strong. It's sort of like to some extent almost anyone can step into a certain position and things can't go too far awry. In startup land, regardless of how great your business is, you are fighting a bunch of other businesses, and execution is very important for who emerges as the winner. And you need the best people to do that. And there's this like constant battle as you become a larger business to acquire much more talent every year. So when you're growing from, for us, 3,500 to 5,000 employees versus the years that we were adding 100 employees in a given year, much harder to add high quality talent at that scale, number one. And then number two, there's just like this inherent equation around like the larger your company gets and the more representative your company is of the broader workforce, the harder it is to maintain above average talent. Just definitionally, as you become bigger, you're pulled back to the mean. And so I think, companies that execute on talent management well and can kind of maintain this outlier status in terms of the types of talent that they can attain on average, I think that's a really big competitive advantage that does manifest over time in financial metrics.
And final question for you both, and perhaps Adam, we can start to you, and then Zoe will go over to your way. But it's one thing to like reach $1 billion and become a unicorn, and staying in that status is a completely different challenge for companies. So with a lot of companies struggling in recent years because of the economic headwinds that we might have seen, what can we learn about surviving through the tough economic times that we've run into?
Yeah, so this is interesting. So I was at a startup during the kind of boom during COVID in 2020 and 2021, and then the bust in 2022. And I think all of us have a lot of lessons from that time period. The thing that I took away from that, I kind of go back to some economic theory here from the investing side. It's like, there's so much focus from investors around, what is the hottest trend in the market, or, what sector is hot, what are multiples doing. There's all these things that kind of like move around on a day-to-day basis. But if you look over a long enough time period, it's like a very, very clear relationship of like, prices kind of bounce around, but it's like the earnings power of the business is what determines the value of the company over time. And like, yes, like there's a time where there's like kind of the average multiple, and sometimes that multiple gets higher, sometimes it's lower, depending on, what's going on in the broader macro. And the point there is really the true north of the business is just optimizing long-term earnings power. And if you kind of have that internal true north, the things that do that don't really change. It's thinking through what is our financial plan? How do we drive revenue growth? How do we make sure we are doing that efficiently? That's obviously a key theme here today. How do we make sure that we're driving consistent operating leverage within G&A and R&D? There's these things that, regardless of the macro environment, continue to be true. And I think the challenge that occurred in 2020 to 2022 were a couple of things. First of all, there was this view of, hey, there's this like very new valuation paradigm with zero interest rates that is kind of like the new norm, and therefore companies that used to be valued one way should be valued in a completely different way. And then second, it's like, hey, like, in a low interest rate environment, earnings aren't that important. ROI of investments, you can accept a lower hurdle rate on those investments. And people got pretty far off sides. And I think there's a lot of talk amongst investors and companies, and there's kind of this, really big, circular loop of people kind of taking advice from other people and doing kind of like what the other companies were. And sort of what I'm driving at is you kind of need, as a CFO or a finance person at a company, to have your own internal true north and kind of keep your own counsel. So I think a mistake that I would admit I made was kind of listening to outside advice, be that from investors and sort of how they approach things during fundraisers, or other advisors to the company. And sort of like you have to have your own view around like, hey, if I make this set of decisions through cycle, is this going to be something that is sustainable and is going to put this company in a good spot and set us up to succeed? And so that's kind of what I would think about and make sure that you always hold true to when you're guiding the strategy of the company.
Zoe, what would you add?
Yeah, I think if we're talking about when times are difficult and, what we've seen over the last 12 to 24 months, I do think that effective cash management, proactive, cost management is important. And we've seen that as being a key to longevity to get the companies to where they are today. But yeah, I think back to basics in terms of understanding like earnings do drive outcome at the end of the day, especially over the long course of kind of 10-year journey. And, Adam's right. A lot of times there is a bit of a tension between kind of internal management of your financials and then what someone like me wants to see in the seat of, things are moving fast and just visionary and this and that. And those two things often can be at odds. But if you really are, strong in terms of having a backbone of a sound financial plan, I think it makes all the difference in the end.
Awesome. Well, thank you both for answering all of my questions. But now we'll turn it over to the group for any questions you guys may have for Zoe and Adam. One thing I would ask before you ask your question, introduce yourself, name, title, company that you work for, and then we can answer the questions that are top of mind for you all.
How are you? My name is Eric Levine. I'm at Open Yield. We're a fixed income marketplace. One of the questions I had, you talked a lot about talent, hiring the right talent. And then, we're also kind of seeing what the emergence of early AI replacing jobs is looking like, how that's taking shape. How do you value in the cost savings from the potential to not need to hire as many human agents, let's just say, or humans to do a job that maybe a much cheaper AI can do? How are you valuing that cost savings over time in your valuation models?
I don't know that we're necessarily, taking that into account when we're, thinking of what we think a company should be valued at per se, because at the end of the day, if you're able to achieve what you need to in order to hit your growth with less people and more use of technology, then you should be doing that. And I think that's going to just be the wave that we're seeing. And, on some roles are going to become more and more important and some are going to become less important, and being able to balance that depending on the type of business that you're operating in is going to be crucial in terms of leadership, I think, moving forward, and making sure that you can set the direction so that you don't have a employee base that is worried that they're going to lose their jobs because of AI. I think if you have clear direction as to the business being sound over time and being durable, then that kind of trickles down into your employee base.
Yeah, I mean, the only other thing I'd say is not like be able to predict the future, but the first order of thinking would be like, yes, like AI automates this job, so therefore margins should be higher. I think there is a line of thinking which I think is not improbable, that you automate away customer support, there's more margin available in the business, and instead companies then invest more in R&D or other areas within the business. Because that's what competitors are doing. This technology is not proprietary, so you may be using automated, customer support software, but your competitors are as well. And so there is kind of this dynamic of like long-term economic theory would say like, hey, like you have a cost of capital, you have a return on that capital, that implies a certain margin. And so I think like the shapes of the P&Ls for companies could change, but I think, and I think potentially the innovation of those companies, the speed at which they operate, what it means in order to be successful and the broader market in a world with AI could be quite different than it is today. But I don't know that it actually for sure leads to higher margins forever. I think it kind of like there's a rebalancing that occurs.
My name is Rafael. I'm VP of Operations at Graphite. My question is for both of you. So how are you seeing finance teams start to use AI on a day-to-day basis? And I ask this as someone that leads finance team. I've seen that the
Yeah, I'll start with that. So we do look at a lot of the AI tools. And again, to this point, the ones that we've demoed and then put into kind of like a test environment to kind of prove out the use case before we pay for it and use live data, so far they have not delivered on the promise that they claim. Now, that being said, there are certain vendors that we've engaged with where kind of like they had an initial use case that they pitched, didn't work out, but there's a narrower version of what they said that they could do that does make sense and does save time. So the types of those things so far on my team typically are things that are lower value, repeatable work. So think of reconciling your balance sheet or spreading financials for the risk team. And there's tools that can take probably hundreds of hours, for a big company like us for those reconciliations out of the team. And that's actually very important in accounting, by the way, because a lot of you kind of staff your accounting team to the average, but they actually have a huge peak during, for us as we think about at some point potentially going public, 5 to 7 days at the end of the month to close the books. That's when the peak of the work happens. And so if you can pull out hundreds of hours from that process, that frees up my team's time to do more flux analysis and flag interesting things to the FP&A team that they see that we should dig into. And then on the risk side, I'm giving some specific examples so you can understand how we think about it. There's tools that not only extract financials, which that's existed for some time now, but it'll actually do a write-up around like, hey, based on what we're seeing, this is what's happening with the quick ratio and the credit profile, and these are things you should look into. And I've actually found those to be quite valuable. So I think there are more use cases emerging. I would imagine if we're having this conversation in a year, there will be a much broader set of use cases. But I also think that the overarching narrative around like how much AI can do still is running a little bit ahead of the reality, at least for us.
And I think even in terms of the types of companies that I've been pitched, for example, which oftentimes is indicative of the types of solutions that they're trying to provide or problems they're trying to solve, they're becoming like more and more niche, more and more verticalized. And I think that's a very good sign for non-engineers and very specific use cases, because right now, oftentimes, if there is some sort of effort required to figure out how this is going to save someone time, they might not make it unless they've already seen how it can, resolve something in a faster period. So I think that we're, again, on the cusp of having much more verticalized solutions, much more niche use cases. And I think that will make it a lot easier for teams, especially outside of Eng, to start to utilize in more broad form.
Probably have time for 2 more questions.
Yeah, so I'll answer in a couple ways. So the first thing I'd say is churn is a very broad topic. I think the thing that you need to understand, first of all, is what is driving that churn. And what I mean by that is there's a few different, you want to look at your churn on a cohorted basis and understand for customers who onboard in a certain month or a certain year, follow that customer cohort over time, because there's different shapes of that retention curve. So you can see a steep drop off in the first year, then it's flat thereafter. You retain every customer after the first year. There's other versions of that curve where it's a kind of like linear kind of like line and it goes straight down, and then there's other curves that are like shallower and then like kind of flatten out very early in their life cycle. Each of those curves I just walked through tells you that there's a different problem. The one that kind of is very steep at the beginning and then flattens out tells you that you have an issue with probably implementation and helping people realize value for the product up front. But good news is if customers find value, they like the product and it's very sticky. The first version is the best retention curve, which is like you have very minimal drop off at the start and then it's flat very early on. The one that's kind of like linear or like accelerating, that's like the worst curve, which is like longer term. You kind of have these melting ice cubes that you're signing up every year, which is a very tough problem to solve. once you've diagnosed the issue, a couple of things, I don't think I'll give the most comprehensive answer in a couple of minutes, but I think a couple of things that we've done in the last year or two that I think have been very helpful. So first of all, having incentives explicitly tied to retention for multiple teams. And we actually have two different teams, one, the customer support team, but also an account management team, which is also a pseudo sales team. We don't want those people only focused on sales. They also need to care about retaining the account, because if you think about those account managers and if their incentives are only geared towards selling, you will actually bombard the customer with outreach and also not really care about setting them up for success. So balancing those incentives was actually very impactful for us when we made that change. And then the second thing I'd say is you need to have a good feedback loop between your account management or technical account management team and the product team, so that they can understand, here's like the list of like the 5 or 6 features that are causing the most significant churn. And it really is just kind of like going down the list and making sure that you have an adequate balance, or the appropriate balance, between new feature development for growth and then also feature development for retention, and balancing those two things properly.
We've got time for one more question, if anybody has one.
I'll ask another one. A little more general question. What are some best practices that you both are seeing that the most successful, or like the three of you are seeing that the most successful finance leaders are doing to be effective at their jobs?
Do you want me to start?
About yourself?
No.
I guess, like, from an outside perspective, obviously, I'm not working with the finance teams every day. I'm often working with the founder. And from the founder perspective, I think it's very obvious when they have a strategic CFO versus one that is too deep in the minutia. And I think that is absolutely what separates kind of the quality and caliber of even just the executive team, and the ability for the founder to make thoughtful decisions with the metrics, with the financial plan. And so as much as kind of a CFO can be skilled up to be that really advisor, I think there's also a lot more longevity in them being partners to the founder through the course of, IPO.
Yeah, I would agree with that. I think that you are seeing actually a trend in the market. If you look at Block as one example, a firm, like, you are seeing a number of CFOs who are becoming COO. And that's a reflection in title of what Zoe's talking about, which is really these CFOs coming in. And where, I think I add more value is not really like budgeting or things like that. It's, we put together the long range plan every year. We understand, like, here's like 3 strategic questions we're going to deep dive into. Here's like how we think about the major drivers for the plan, or here's a new go-to-market motion that we're standing up. How should we construct it? What funnel metrics do we need to see? Sort of what is the attractiveness of an investment in this area of R&D versus that area? These are the types of questions where I think that most of my time with our CEO is focused on. And so I do think being that thought partner and kind of having the ability to drive company strategy is interesting. And one of the things I would say that's exciting about Rippling and some of the other companies I've worked at is, and this is just my specific experience, one of the things I've enjoyed is that when you work at a company that has a fintech element, what you tend to see is, because of the nature of money movement, of risk associated with that money movement, because of the fact that I'm a user of the product, if you think about spend management and things like that, I think the CFO role also can have a much greater impact because you're much more involved in the growth of the business. We provide feedback to the product teams on the build out of the product. We are involved in constructing the risk policies tied into the product, and risk is really part of the product experience for us. Money movement, so payroll, obviously. So constructing those rails to move money to whichever country you have employees in, that's something that also sits with my team. And so I think those are some of the things that are interesting. If you kind of think about the business model that you're going to, think about what does the CFO role look like? And I think it actually varies quite a bit depending on the type of industry that you've selected.
Amazing. Well, thank you all for all of your great questions. Adam, Zoe, thank you for answering all of our questions as well. We have about an hour if you guys want to hang out, grab a drink and some food. But other than that, we'll close on that. Thank you,
Thanks
guys.
for having us.
Thank you, guys.